This chapter is about the basics of capital stock. So when we say capital stock, what we mean is money invested in the business by the owners of the business. Whenever you start a brand new business, if I wanted to start, I have a storage business. If I wanted to, the first day when I was going to start that business, I literally went down to the bank, took money out of my personal account, and put money into the business's account. Okay. And so I was funding the business. I was giving the business an initial amount of money to operate with. And when I did that, I was purchasing stock or a share of ownership in the business. Because it was just my business, I was actually purchasing 100% ownership. I was purchasing all of the stock. But if there were 10 of us doing it together, we might each be getting 10% of the stock. So capital stock just means the money put into the business by the owners. In a small business, it can be a relatively small amount and a relatively small number of owners. In a large publicly traded company, it can be a much, much larger amount, millions, even billions of dollars, and thousands or even millions of potential owners. Probably some of you, whether through your retirement plan or just investments, own stock in certain companies. So that's what capital stock is. It's money contributed into the business by the owners. So a couple of concepts that are going to come up in the chapter that will be helpful to you is, first of all, there's this crazy thing called par value on stock. And when a company decides to become a corporation, they file what's called articles of incorporation with the state where they're located. And in that document, many states require them to put what's called a par value for their stock. This is like this sort of outdated thing that not every state requires, but many do. And it's arbitrary, meaning it doesn't mean anything. So if I say the par value of my stock is $1, that has zero to do with what my stock is actually going to be worth or what people are willing to pay for it at the market. But because we're structured that way, we have to account for the par value of our stock in addition to any money we receive from issuing shares over and above that par value. Okay, and so that creates some confusion. So just recognize down there below, it says there's these classes of stock. One is called par value. And I'll try to give you an example so it's less of a confusing concept. But par value is just this arbitrary amount we assign. Sometimes you'll have stock that's called no par value because the state it was incorporated in doesn't require them to put a par value. And some states call it stated value, which is in essence pretty much the same thing as par value, just some arbitrary amount that the state required you to put on the articles of incorporation. It's funny how many things we do in the world, even in the church, are because we've always done it that way, because this is the rules. One of the things I love about what President Nelson has been doing is I think he's really been looking at a lot of things we've always done a certain way and asking, do we have to do it that way, right? Is there any doctrinal reason that women can't be witnesses at baptisms? And the review said, no, there's no doctrinal reason. So let's open that up. And so I hope that the state governments will follow suit and get rid of this par value concept, but there it is. All right. So the stockholders' equity, we learned in the first chapter that assets equal liabilities plus stockholders' equity. And stockholders and assets are pretty easy to put your finger on, like that stuff that the business owns. And liabilities is pretty easy. That's debts that the business owes. But stockholders' equity is always kind of confusing because it's just the difference between those two. And so if I have more assets than I have debts, my stockholders' equity will be higher. And if I have more debt than I have assets, then my stockholders' equity could be lower or negative in theory, right? And so the idea is this, that stockholders' equity comes from two different places. One place it can come from is when the business owners put money into the business, like I just described, funding my business. That's what we call common stock. Common stock is what we call paid in capital, or capital paid in by the owners into the business. The other form of stockholders' equity is what's called retained earnings. That means when the business earns money and doesn't pay it out to the owners, then we retain those earnings in the business. So that's how that's where stockholders equity comes from, and that's how we fund a business. We either have to put it in as owners or have the business earn money and then don't take it all out. So here's an example of what it looks like when we issue stock at par value. So our example is on June 5th, Dylan Snowboards Inc. issues 30,000 shares of $10 par value stock for $300,000. So the way we record that transaction is we haven't really learned about debits and credit entries yet, and we won't until we look at Chapter 2 stuff. But we're going to debit or increase our cash account by $300,000, and we're going to credit or increase our common stock account by $300,000. So just recognize that when we issue common stock for cash at the par value, our cash goes up and our common stock account goes up. Remembering that common stock means money put into the business by the business owners or the shareholders. But sometimes we will be issuing stock at an amount greater than its par value. This happens when the people who are buying the stock at the market think it's worth more than the par value. So now, again, we're left where we have to account for the par value of the stock and any money paid in excess of that. So in this case, on June 5th, Dylan Snowboards issues 30,000 shares of $10 par value stock for $12 per share. So when we record that transaction, we're going to say 30,000 times $12 is 36,000, or 30,000 times $12 is $360,000. And then we have to record our common stock at the par value, which was only $10 a share, is 30,000. And then our paid in capital in excess of the par value, any money we received in addition to the par value, we record separately. Let me pause here to say, I'm not a formal person. If there's something that just is really confusing you and you want to ask a question, just jump right in, like just interrupt me. There's not an easy way to I mean, you can put it in the chat if you're too nervous to like say speak up, but there's not a lot of easy ways with Zoom to always make your voice heard. So if you're sitting there feeling really confused, don't be afraid to jump in with a question. All right. So this is what a little part of our balance sheet would look like after we issued that stock. It would show common stock, $10 par value, with 30,000 shares issued and outstanding is 300,000, plus the paid in capital in excess of par in the common stock, plus our retained earnings. So that gives us our total stockholders equity of $425,000. That's what the stockholders equity section of the balance sheet would look like after we issued that stock. And remember, issuing stock just means receiving money from owners, okay? Sometimes it comes up that we issue stock not for cash, but instead for non-cash assets, like we exchange stock for land or we exchange stock for equipment. So in this example, they issue 4,000 shares of $20 par value stock for land that's valued at $105,000. So again, we show the asset land going up by $105,000. And if it's 4,000 shares of $20 value par value stock, then we know that that means $80,000 is the par value of those 4,000 shares. So we record that. And then any value over and above that par value, we have to record separately as paid in capital in excess of par value. So we can issue stock not only for cash, but also for other assets. Okay, so I mentioned earlier that our retained earnings is the money that the business has earned. We earn money through selling stuff to people, okay, that we haven't yet paid out to the owners. So when a business pays out money to the owners, we call that a dividend. And there's a couple of ways that you can pay. You can do what's called a cash dividend. You can also do what's called a stock dividend, which we'll talk about in a second. So a cash dividend is where the business actually pays out some of its earnings to the owners. If you ever have invested in stock, you've probably gotten a dividend, or you set your dividends so that they reinvest and buy more shares of the stock. So in order to pay a dividend, a business has to have enough money in their retained earnings and the cash necessary to pay it. And if you think about it, like if you stop thinking about giant corporations and think about like if you had your own small business, the business would earn money through operations day to day. And maybe at the end of the month, you think, I've been working hard for this business. I deserve to pull some of those profits out and treat myself, or maybe put it into my savings, or whatever I'm going to do with it. And so that idea of taking some of the profits of the business and paying it out to the owners makes common sense. Just recognize that when it's a corporation, we call that paying a dividend. Sometimes businesses pay what's called a stock dividend. So that means when a business wants to pay a dividend, the board of directors gets together and says we should pay a dividend to the shareholders, but doesn't have sufficient cash, they can instead give people shares of stock. And so it keeps the market price of the stock affordable, usually, and it's just another way of demonstrating to your shareholders, look how well we're doing. We're able to pay you a dividend. And a lot of times the shareholders really like it, right? If I have 100 shares of stock and they do a 5% stock dividend, I'll now end up with 105 shares of the stock. They differentiate between a small stock dividend, where they distribute less than 25%, less than or equal to 25% of the number of outstanding shares, and then a large, which is greater than 25%. We also have something called stock splits. Maybe you've heard of this. A stock split is something that we often use to keep the stock price in a target range. What we found is that investors often don't like to buy stock that they feel is priced too high. And so what they do with a stock split is they just split in half. If it's it's called a 2-for-1 stock split. So they split in half the price of the stock, but everybody gets issued twice as many shares. So the example we have up on there is that it's a $20 par value stock. There's 100,000 shares outstanding. After the stock split, 2-for-1, now there'll be a $10 stock with 200,000 shares outstanding. So what that means to the investor is it's worth the exact same. They have twice as many shares, but worth half the value. But new investors may look at it now and say, I'm more willing to purchase a $10 stock than I was a $20 stock. This is really awesome sometimes as an investor, because as it continues to grow, that growth is impacting twice as many shares for you. I once, when I was in Texas, I was a broker for Edward Jones Investments. And I met a lady, and I was just knocking on doors, handing out business cards. And she told me her husband once invested in stock. And I said, really, what type of stock did you guys have? And she said he bought Coca-Cola Company back in about 1950. I said, oh, that probably would have done really well for you. Did you sell it or did you keep it? And she said, oh, I still have it. And I said, oh, like you still have the actual physical stock certificate for 50 shares for 200 shares, which is what she said he bought. And she said, yeah, it's in a shoebox back in our spare bedroom. And I thought, I know Coca-Cola has had some splits since then. So like if it split 2-for-1, instead of 200 shares, she would have 400 shares. And then if it split 2-for-1 another time, her 400 shares would split to 800 shares. And I said, hey, do you mind if I do a little bit of research just to see what that investment you have sitting in your shoebox might be worth? And she said, sure, that'd be great. And we went and I pulled up all the historical splits, and it turns out that 200 shares of Coca-Cola in 1950 had split into about 17,000 shares of Coca-Cola in what year was this? About 2000. And so I multiplied that 17,000 shares by the market price, and she had about $2 million worth of Coca-Cola stock sitting in a shoebox in her back room. And so stock splits are sometimes a great thing to you. We just had to hook her back up with the Coca-Cola transfer agent to get a new certificate issued with the appropriate number of shares. And then she met with a lawyer to establish a trust so that she could use that money she actually gave away a bunch of college scholarships to local kids. She'd been married, but they never had children, and she didn't know what to do with $2 million. I tried to apply for adoption, but she wasn't interested in adopting me. Lindsay, I see you turned your camera on. Did you have a question or a comment, or are you just tired of sitting there in obscurity? You have to be seen. Yeah.
I had stopped to eat dinner.
Oh, okay. Well, thanks for not being on camera while you did that. That was nice of you. Um, unless it was something really delicious, and then we could have all, you know, enjoyed the moment, I guess. Um, so here's a little summary. This is actually something that will be pretty helpful if you want to like take a picture of it or something. On one of the problems I saw in the quiz, what's it called? Quiz access assignment. It's just a summary of what happens. So when you with each type of account, when you do each of these things. So when there's a cash dividend, it's going to decrease the total assets because you're paying out cash, and it's going to decrease the stockholders' equity overall by decreasing retained earnings. So a cash dividend, in essence, takes money out of retained earnings and pays it out in cash to the shareholders. Where a small stock dividend, when you do a dividend, a stock dividend, you're not paying out cash, so your assets don't change. Instead, what you're doing is you're increasing common stock contribution by the owner while decreasing the retained earnings. In essence, you're taking retained earnings, money the business has earned, and buying more stock and then distributing that stock to the owners. Large stock dividends are always done at the par, so it'll be the same thing, but no change to the paid in capital in excess of par. And a stock split actually doesn't affect anything from the business's standpoint. There's no assets paid out, no debt taken on, and the common stock isn't. You didn't purchase new stock; you just split the price in half and double the number of shares outstanding. So this is actually a pretty good little summary. There'll be a problem that we'll use that. Just a few more here. I'll try to get through this quickly. There's another concept which is called preferred stock that they're going to bring up. So preferred stock is different than the common stock that you and I can buy if we go on our Robinhood account or something. So preferred stock is a special type of stock that is issued usually to, we'll just say like high-level investors in the company and people who are serving like on the board of directors or other people who are close to the company. So preferred stock is different, and the reason it's called preferred is because preferred stock will get paid its dividends before common stock will. Where it's not preferred is common stock gives you a vote. Each share of stock you have lets you vote for who the board of directors and things like that for the company are. Preferred stock doesn't give voting rights. So it looks a lot like when we issue common stock, or when we issue it, the business's cash will go up, and then its preferred stock will go up. In the same way, if it has a par value, it'll go up by the par value, and any money we receive in addition to that will be in excess of par. So just recognize there's another type of stock called preferred stock, but the way we record the issuance of it is very similar to common stock. So here's reasons companies issue preferred stock. It helps them raise money, but they don't have to give up voting rights. So, and it appeals to certain types of investors. Some people think common stock is too risky. Preferred stock pays more steady dividends out than common stock does. This is just a concept that will come up in one of the problems. There's two types of preferred stock. One is called cumulative preferred stock, and the other is called non-cumulative preferred stock. Cumulative preferred stock is preferred stock that guarantees dividends. So even if the company loses money one year and can't pay dividends that year, then the next year, before any of the common stockholders can get dividends, the preferred shareholders will have to get their dividends from the previous year. Those are called dividends in arrears from previous years, and their dividends for this year before the common stockholder can get anything. And so that's just the definition of, that'd be one of those, if I was doing an assignment and I forgot what that definition was, I'd go to that summary of terms at the end of the chapter and look it up. Non-cumulative stock doesn't prefer that, or doesn't guarantee the dividends. That's the big difference. All right, one more concept here. Well, not one more. Another concept here is treasury stock. So sometimes after a business has issued stock to stockholders, remember we usually issue stock because we're trying to raise money, right? Like if I'm trying to take my business to the next level and I don't have $1 billion to do that, I might sell off a portion of my business to other shareholders and then use that money to grow the business. Sometimes a business grows to the point where you're ready to sort of buy stock back, okay, saying, I don't need all of that stock out there. Now we're doing well financially. And so they'll buy stock back in that's already been issued. When we do that, it becomes treasury stock. It means the stock of the business that's already been issued, but has been bought back into the business and held in the business's treasury. Okay, that's why they call it treasury stock. And a lot of times we use it. Well, this has the examples up here. I said number 3 is a really common reason. If you ever have participated like in an employee stock ownership program, usually what you're doing is you're buying stock from the company's treasury stock. Again, all it means is stock that has been sold and is out there for sale on the secondary market that the company buys back in its own stock. Let's see. They want you to know how to calculate earnings per share, price to earnings ratio, and dividend yield. I'll show you those formulas. Earnings per share is just our net income. That was from our income statement, our revenue minus our expenses, minus any preferred dividends, divided by the weighted average common shares outstanding. So that's the formula for it. Often they will give you this number, weighted average common shares outstanding. If they don't, then it's a little tougher. What you have to do is figure out how many shares were outstanding at the beginning of the year, plus the number that were outstanding at the end of the year, and then divide that by 2. And that will tell you what the average number of shares outstanding for the year were. What this tells us is if you think about it, it's earnings, which is our profit or net income per share. And so, if you ever go to Yahoo Finance and look up, one of the things it always shows is EPS. And that's saying this company made this much profit per share outstanding. And that can be really helpful if you're trying to compare a couple of similar companies. Price to earnings ratio is just the market price of the stock. Again, if you're looking for a publicly traded company, you can go to Yahoo Finance or MSN Finance or several others. And you just take that market price divided by the earnings per share. And that gives you what's called the price to earnings ratio, or the price divided by the earnings. Again, this gives us a measure of relative to the earnings per share, at what level is this stock trading on the market? Okay, so it compares those two concepts. I recognize, I really feel like we're dumping this stuff on you guys early. In other words, I prefer for it to be in chapter 12 near the end of the course. And so I don't think that you have to be an expert in price to earnings ratio to get through this chapter, but you may have to be able to apply the formula, right? Like and recognize a little bit about what it means, and recognize that as you go through more of this, it'll become clearer. That's what's hard, right? I feel like in some ways, the way the course is set up, where you should still be playing chopsticks, but we're jumping ahead to maybe not like some symphony or concerto or something, but we are jumping ahead to say like one of the hymns made easy hymns, and it takes a little bit of work to get to that. And then finally, dividend yield, which is just going to be the annual cash dividends per share divided by the market value per share. Again, with some context, I think this will not be too bad. It'll be doable. So that's the end of my little presentation. Anybody have any questions about things I mentioned in the presentation that you might want clarified? I know a lot of it you don't have a lot of context for, and so it's hard to ask a question about it until you get into it, right? And then the questions come up. But any questions on this?
Hey, Brother Fox, a quick question.
Sure.
With the equations and things like the 3 or 4 that were talked about tonight and in this week's material, like with the quizzes and things we do, there's still like the book you can pull up that gives a link to, help with this question. But as far as like when we do the exams, like we have one coming up in a couple weeks, will we need to know these equations, like have them memorized to know what they are?
Yeah, so it's a good question. And so the short answer is I know that the exams are closed book. I don't know yet what all content is on them. A group of us instructors are kind of working together to build a study guide for the exam because we feel like we don't want you guys just left completely with it dumped on you. And so I guess the short answer is you probably will have to know a lot of like how to calculate these things, but I won't know for sure until I can get a good review on that exam. And like I said, last week has been so full of putting out fires, I haven't got to look ahead very much. But yeah, it's been a frustration of students each time that the exams are closed book with no notes or anything.
Gotcha. Thanks. No, yeah, study guide at least will be good. So
Yeah,
keep an eye out for that.
we're working on it. We'll try to get it out, with at least several days before the exam, so you have time to look at it. Other questions I can dodge, like that one. I'll assume somebody laughed at that, but everybody's on mute, so I don't know.